lot of people don't understand the difference between commercial lending and residential lending, or like retail lending, or I don't know the exact terminology for it, but basically when you buy a house, you're getting a different type of a bank loan than when you're going out and buying a 40, 50, 100 unit apartment complex.
Correct.
And can you explain the difference between that and maybe the difference in underwriting, or how it all works, or
How the picture's kind of looked at that way.
yeah,
So,
how are they different?
Residential mortgages are structured with longer terms normally. So you'll get anywhere from usually a 15 to a 30 year with a residential purchase. As in comparison to on the commercial side, you are going to get a shorter term. It's usually, most financial institutions will offer 15-year. They can amortize the payments longer, but your term will actually be 15 years, so it will balloon out at that time. So that's one way the terms are different. Underwriting is a little bit different as well. So when you're looking on the residential side, we look at your income.
Right.
So we're going to take your income and we're going to take your debts, and we're going to get a debt to income ratio. So you would take your debts and divide it into your income, and that would give us your percentage of debt to income.
Sure.
So we would look at that, and based on any financial institution's parameters, and most of them have about the same, but a little bit leeway of difference, what percentage they want. On the commercial side, we're going to look at debt service coverage ratio, which means we're going to take the net operating income and we're going to divide it by the debt that needs to be serviced. And that ratio is, normally financial institutions are going to want you to be at a 1.2 to a 1.25. That's where they have their comfort zone. Meaning if your debt service coverage comes in at 0.95, that means you are able to cover with your net operating income 95% of your debts. So that would make an institution a little leery to lend anymore if that's all you can cover. It means you don't have that room to cover any additional debt.
Right.
So if you're coming in at that 1.25, that means you can cover 100% of yours and a little bit more, which makes you look really healthy and good.
Right.
Gotcha.
So if that's an explanation of the differences between the two.
So when it comes to like residential lending or personal lending, you're talking about debt to income ratio. So the income is basically your W-2 job, typically.
Yes.
Right? And it's generally pretty hard, at least I've experienced. It's definitely a little bit more challenging to get a conventional home loan or a personal loan like that. Say if you have your own business, right? Like W-2 really helps out because it's very black and white. It is what it is when it comes to residential.
Yeah, it makes the puzzle easier to put together if you have a W-2. We work with a lot of business owners, and we have a great underwriting group that does do tax analysis and credit analysis. So they'll take your tax return if you're a business owner and pull apart as much as they can, to figure that out.
Sure.
But you are right. So W-2 wages it's black and white, like you said. You pull a number, and then you're going to take the debts and divide it into that.
Yeah. So your ability to borrow, the amount that you can borrow in loan, is determined by basically how much you make when it comes to personal, right?
Yeah.
So the value of if you're trying to go buy, 4-unit property, that still would qualify for a conventional home loan, but your income is very important in order to qualify to borrow the amount of money for the personal home loan for that property.
It is. And I'm not as familiar as the loans on that side, because on a 4-unit, we could still look at it on the commercial side as well.
Yeah.
But you're right. Especially if they're just getting into rentals, new to rentals, hopefully they're going to be credit strong themselves personally, because that's going to be weighted on the decision.
Versus commercial, where your ability to borrow is dependent on the income of the property.
Right.
Yes. So we're going to look at, and there's still a lot more that we look at, but that is definitely a good strength that you need to have. A solid property, and that the rents flow through, that it's going to cover the debt that you're taking on from it.
Sure. So when we come to you with a property, right, and we're like, hey, Melissa, we have a property, you need to let this on. What are the things that you guys are going to run through and be like, okay, we want to make sure it has 1.25 DSCR.
Yes.
What else are you going to want to look at?
Like I said, we're going to look at, it's a huge puzzle that we put together. We do look at the strength of the property, sometimes location. We're going to look at what your occupancy is already, so how many vacant apartments you have that you need to fill, and does that seem doable?
Yeah.
Solid on the property, I mean, is it in great condition, or are you going to have to spend a year and a half rehabbing that property? That's kind of a big deal too, or is it rentable right now and people in it? Again, debt service coverage, we do look at that because we want to make sure that you're going to be able to handle that debt that you're taking on. And in a lot of circumstances, we have guarantors still on the loan. So there are people that are still going to stand behind it. We want to know who's managing it. That is a huge deal. Do you come with experience?
Yeah.
You're going to come in and buy a 100-unit rental and you've been working in the restaurant business, for 20. We're going to say, okay, this may be more risk for us because are you going to be able to handle what you're taking on? Even if the financial part looks really good, we still have to say, are you going to have property management? Are you going to have someone that helps you, or who experience is going into that deal with you?
Kind of the intangibles that are very important in business outside of just the numbers.
Right, like I said, it's this huge puzzle, kind of putting it all together. But that service coverage ratio is probably one of the prime things that we're going to look at.